I'm joined by Richard Lacaille, Global Chief Investment Officer at State Street Global Advisors, which has $2.1 trillion under management. Richard, really good to see you. When you look at what happened last week, is the volatility that we saw, if I can put it this way, justified? Do you know what I'm trying to get at? Was it driven by fundamentals? Was it driven by emotion?
I think there's a lot of fundamental drivers that absolutely justify both the volatility and the falls in share prices that we'd seen in previous weeks. Perhaps not to the magnitude, but certainly partly. You've seen concerns about US growth, revisions to the data, although stronger retail sales towards the end of the week. But you've seen some weakness in US data, again reflected in the FOMC decision to really lengthen that period of low interest rates.
And it just didn't take very much at all to really freak the markets out.
Well, I think there were a number of things, and the timing of the US downgrade was obviously something that capped a week of relatively bad news and relatively bad sentiment. We've been saying to our clients that the falls, certainly this week, or at least last week, haven't been really to do with the US downgrade as much as other concerns. And I think things that people should be concerned about are US growth, and they should be concerned about the continuing challenges that we face in the eurozone, and not so much about the US downgrade as such.
Communicating to your clients must have been pretty key last week.
Well, I think we all had a stressful week. Our clients had a very stressful week. And certainly the portfolio managers and the researchers had a stressful time last week. But it's very important at times like this to communicate what we think are the really important things people should be focusing on.
Which are?
Eurozone. I think the Eurozone continues to be a source of potential risk. And in terms of financial contagion, it's a much bigger risk, perhaps, than whether the US growth rate's slightly lower than we would have expected or anticipated. And I think US growth rate is a challenge, but it may not be as nearly a bigger challenge in terms of a left tail risk as the events in Europe.
Are we perhaps seeing now a buying opportunity, or is it just too early to call that yet?
Well, I think probably together with a number of other managers, we look at a number of different signals. We look at valuation indicators, we look at momentum and sentiment for markets. A number of the valuation indicators are showing that markets are becoming more interesting, more attractive, certainly compared on a yield basis with fixed income, for example. But we also know that value can be a trap. You've really got to look through for a little bit more clarity as to some of these dangers becoming at least eliminated or at least ameliorated in the coming weeks.
And what sort of dangers do you see on the horizon that people should be really watching out for?
Well, I think the Eurozone, again, is a serious challenge.
But that's been a serious challenge for such a long time, and we've just limped from crisis to crisis. Do you think that's actually been factored in, priced in, or really we're in for more shocks?
I think as the markets have begun to focus more on the very large economies within the Eurozone, Spain and Italy, and the relative slow pace of response to that, which is not a criticism of anybody, it's just inevitable in the political process that responses are difficult to make as quickly as the market would want. Then you've got to continue in danger in those very large bond markets. And the ECB response to buy in the secondary market has obviously driven yields down to a sustainable level. But it's only a bridge, and the question is whether the political will is available in Europe to really go the extra mile.
What's the key when you're looking to put that money into portfolios? What are the key things that now you are looking at? What are you choosing? What are you liking? What are you running a mile for?
Well, you can't make these decisions in isolation of client needs. So we've got clients who absolutely need security, liquidity in our money market funds. We absolutely have to have very large amounts of liquidity, very, very high security of principal. But obviously for long-term investors, it's impossible to avoid risk altogether. If you're going to make long-term returns that are better than the risk-free rate, you're going to beat inflation, you have to make some decisions. And so for those longer-term investors, valuation signals are perhaps much more important than worrying about what might happen this week or next week, which frankly is pretty unpredictable anyway.
What about the ban on short selling? Is that making any difference at all?
Well, it will have made a difference to the balance of buyers and sellers towards the end of last week. We're no fans of short-selling bans, but in the sort of fevered atmosphere that you had last week, I think the chances of market abuse emerging as a result of false rumours or other actions by people have obviously heightened. So I can understand why the short-selling ban has been approved, even though it's not something that we favour, and we think, in fact, it sucks liquidity out of markets.
Do you have any exposure to peripheral Europe?
Well, we have. We manage $2.1 trillion in assets. We have clients who have index funds that cover every market, practically every liquid market in the world, from large cap to small cap. So we are, or our clients are, exposed to developments pretty much everywhere.
And taking that longer-term view, commodities, that sort of area as well, any specifics there that I can pin you down on?
Well, I think commodities have been interesting for clients for a long while because they've offset some of the movements we've seen in other parts of the portfolio. And if one of the lessons of the last several years is diversification is quite hard to obtain. Commodities gave that diversification. Now we're seeing commodities more attractive as an alpha source, and particularly spotting the differences between commodity prices and focusing perhaps on short-term trends in commodities. Those sort of strategies have done well in the last couple of months compared to strategies that just exposure to markets as such.
There's a lot of talk about maybe we're on the tipping point of a double-dip recession. We had Robert Zoellick of the World Bank saying, you know what, this is a very dangerous point that we're at right now. Do you take that fairly pessimistic view about where we are right now in the economy?
Yeah, it would be foolish to deny that the chances of a double dip in the US have increased. So we think the chances have increased. However, our central scenario is still not that we're going to be facing a double dip, and that we'll just face what we've predicted for the last couple of years, which is slow growth. It's a grind out of this difficult situation we're in. The deleveraging won't happen instantaneously. The evidence seems to be that people are deleveraging actually pretty slowly.
And is there really light at the end of the tunnel, sort of like when you look at a timescale and you think, well, you know, in 1 year, 2 year, 5 years, we will be back to something that we might consider normal, or are we in the new normal?
I think there's a lot to be optimistic about when you look at the economic developments from a trade perspective. From free trade perspective, we've held up incredibly well over a difficult period. And certainly for investors in private sector securities, whether it's equities or corporate debt, that's incredibly important because that free trade allows people to run their businesses freely and to take profits from globalization, and that doesn't seem to have ended. We haven't got tariff barriers, we haven't got any interruptions to that. So that gives grounds for a lot of optimism because there's lots of potential for growth in the world outside the developed, mature economies.
Okay, Richard Lacaille, really good to talk to you. Thank you very much indeed for joining us here on Bloomberg today.